Okay, so today we're going to tackle one question I'm getting in real estate a lot: down payment assistance and co-ownership. Is it good or bad? So, is this the solution to your home ownership dreams, or is this a decision you might regret later? I'm Lauren Andrews from Dominion Lending Center's Expert Financial and OptimalFinance.ca. So first, let's quickly explain what down payment co-ownership actually means. It's a new way to buy a home where a company helps you with your down payment in exchange for a sharing ownership of that property. So instead of lending you the money like a traditional loan, they invest alongside of you. They might contribute, say, 5% to 15% of the purchase price to boost your down payment. And in return, they get a portion of the equity of your home and a share of your future increase in its value. There are no monthly payments to this partner because there's no interest rates, because it's not a loan. Sounds pretty good, right? Well, it can be, but let's talk about the good stuff first. So one of the good things is an easier entry into home ownership. The biggest advantage is that it helps you get into the market faster. If you're struggling to save a full down payment, a co-investor can bridge that gap. This means the difference between buying a home now versus waiting years to save more. Next advantage, you have a bigger down payment, which could potentially mean less debt. So with their help, you would reach a 20% down payment, which would save you from paying mortgage insurance and lower your monthly mortgage cost. You'll need to borrow less, meaning smaller mortgage payments and potentially lower interest rate costs over time. Always keep in mind that your minimum down payment as a borrower has to be a minimum of 5% up to a purchase price of $1.6 million. If you're purchasing above $1.6 million, you would need 10% down to the maximum purchase price of $2.5 million. Another advantage is you're increasing your purchasing power. So when you have a full 20% down payment, many things change, including your overall purchasing power. You no longer are restricted by the regulations of the insurer like CMHC has in terms of the income to debt ratios, and this could dramatically increase your purchasing power. So for example, a family that has a combined income of $160,000 per year with less than 20% down payment would qualify for a purchase price of about $610,000. With a full 20% down payment, depending on the lender that we choose, the new purchase amount could be actually close to $1 million. So for families that have been priced out of the market because of where their purchasing power was, this could actually enhance it to get the type of home that they could get that would be suitable for their family. Another advantage is no monthly payments to your partner. Unlike a loan, you don't owe monthly payments to the co-owner. This can really ease your cash flow each month. Instead of a second loan payment, you just share a slice of the pie when you sell. Another advantage is there's risk sharing. So if the housing market drops in value, your co-owner partner also shoulders that loss with you. You're not alone in the risk. They absorb a part of the downside because they only profit if the house gains value. For clients that have purchased it back in 2021 and early 2022, many have seen decreases in their values over the last few years. There is absolutely no restriction when you sell the property. So homeowners that were in a situation that ended up selling their home for less ended up having some of their losses absorbed by the co-ownership partner. So let me give you an example. This is a really bad case example, but let's say you got $1 million property you purchased and that value dropped by 20%, which is that $200,000 down payment. The decrease in the value by that same amount that you've actually put in. So the homeowner would not owe anything to the shared equity partner. They would walk away with zero, but the homeowner would retain all the equity from the principal payments that they've made towards that mortgage. Another advantage is closing costs. So because we have a full 20% down payment now, we eliminate the need for the insurer. So there's no more CMHC, Sagen, Canada Guarantee insurance. For example, a purchase of $750,000 that has a minimum down payment, the CMHC fee on that alone is about $29,800. The other significant factor is the land transfer tax that is due on closing is distributed according to the equity share. So if the homeowner put 10% down, they would only be paying 50% of the land transfer tax, for example. And I think we have to mention title. So another important factor is that the co-ownership partner is not on title of the property. It's just the homeowner. And this allows the homeowner to have the freedom to be able to move the mortgage from one lender to another. Another advantage is the equity portion only applies to 20% of the property. So if you're purchasing a property with the full 20% down payment, of which you have at least 5%, this means 80% of your property is financed, and you'll be making mortgage payments, paying down the principal. It's important to note that that 80% is always the homeowner's equity. So if Aunt Edna won the lottery tomorrow and gave you money to pay off that mortgage, that portion is never part of the equity share. Another advantage is renovation credits. So the question I get from time to time is, hey, listen, I want to renovate this home, I want to improve the property, but how does this work in this program? So doing the renovations is obviously going to have a net benefit that will benefit both you and the co-ownership partner. But you're the one that's laying all the cash out. So how does this help? Well, there's a renovation credit that could be given to you. And once you sell that property, all parties will benefit from the increase in the value, but you'll get additional credit to cover the cost of your renovations. So far, so good. It's helping people buy homes that might otherwise not be able to afford one. But before we celebrate, we need to look at the potential downsides. So now the drawbacks. So sharing future gains. The big one is that you have to give up some future profit. So when your home increases in value, you won't get to keep all that appreciation. For example, if the homeowner contributes 50% down payment, they may claim around 50% of the home's appreciation when you sell. This could be tens of thousands of dollars, and it wouldn't be in your pocket because it goes to them. But it also need to point out the flip side of this. If the only reason that you're not purchasing a home today is because of down payment and you're trying to save more, you definitely need to calculate how long it would take you to save that down payment to get into a home. So let's say, for example, you're looking to buy, let's say you love this $800,000 home, but it's going to take you about 4 years to save the down payment you would need to be able to get into that particular home. Now, if we just calculate an average appreciation of 5% per year, that same $800,000 home is now going to be about $972,000. So the equity we just gave up by waiting is $172,000. All right. So another point is the equity isn't all yours. So even though you live in the house, the sense that it's not 100% yours, psychologically, some people feel uncomfortable knowing that there's a partner that owns a chunk of this home, okay? And if you ever want to tap into your equity later, say for refinance or HELOC, having a co-owner could complicate things. So these programs also have the ability for you to refinance and pay out the equity partner. There's never a restriction on when you sell. But if you're refinancing to pay out that property, they are going to expect a minimum rate of return. Another disadvantage, there's a limited upside if the market soars. So your property value skyrockets, the co-investor's share also skyrockets. In hindsight, you might feel that you've paid a lot for the help, whereas in a traditional loan, you'd be paying the interest but keep all the appreciation. Another drawback is there are lender restrictions. So there are some restrictions in this program in terms of credit, for example. You need a minimum 600 Beacon credit score. And if you're purchasing a condo, for example, there is an age restriction on how old that condo can be. As this program expands, there's more and more lenders that are accepting co-ownership financing. Currently, there are both A and B lenders that are doing this program. Your purchasing power would definitely be increased with the alternate lenders. And they often have programs, especially if you're self-employed and because you're using stated income programs, they usually require a full 20% down payment. This particular program can be used with those ones as well. Another drawback is there's area restrictions. So this isn't available everywhere. So you have to understand that they're looking at locations that are going to appreciate over time. So right now, the locations that this program is available is really the Greater Toronto area, which includes Toronto, York, Durham, Peel, Dufferin, Halton, and also Hamilton, London, Kitchener, Guelph, Waterloo, and now Ottawa. The program is only for owner-occupied properties, and you do not have to be a first-time home buyer to use this particular program. So this is not a forever program. So even though there's no restriction on selling the property, and you could keep it for 25 or 30-year amortization of your mortgage, it's not what the program is designed for. And it's strongly recommend that you don't do this. It's designed to be a stepping stone. The idea here is to leverage real estate and the increase of the value of the real estate to build equity, cash out on that equity, and go buy a home outside of a program like this. I'd like to put this actually in perspective. So if you had $50,000 to invest in, let's say, a GIC that earned 10% per year, okay, you'd have $5,000 in 1 year. But if you were to invest $50,000 into $1 million property that appreciated by 10%, you would have $25,000 on your $50,000 investment. That's a 50% rate of return on your investment. This is one of the main reasons why people want to invest in real estate, because they are increasing equity based on the entire value of the property. And then you can leverage that equity for your next purchase. So is down payment co-ownership good or bad? Honestly, it depends on your situation. For buyers who can't quite save enough or are tired of waiting while prices continue to rise, this option could be a game changer. It could turn no, I can't afford a home into yes, I'm moving in. In that sense, it's very good. It helps people build equity and stop renting. On the other hand, if you have savings or other reasons for down payment, you might prefer to keep full ownership and not give up any future gains. If you expect the home's value to jump a lot, co-ownership could be very costly in the long run because of the equity you have to give up. It doesn't necessarily make it bad, but it means you're paying for a benefit in a different way by sharing the appreciation instead of paying interest. It's a trade-off, less money needed now in exchange for less profit later. So here's a quick recap. Co-ownership down payment assistance can be a lifeline. If you're short on funds today, it brings home ownership within reach with no extra monthly debt, and it shares the risk of the market ups and the market downs. But remember, there's no free lunch. You're parting with the share of your future home's equity growth. Whether that's worth it or not comes down to your personal finances, your market outlook, and your comfort level with a partner in your purchase. So if you're considering purchasing this route, do your homework, research the specific programs, run the numbers and the best and worst case scenarios, and always talk to a mortgage professional or financial advisor who can walk you through the pros and cons in details. Make sure that financial advisor or the mortgage professional are familiar with this particular program. They can help you decide if co-ownership is a smart move or not for your unique situation. Listen, thanks for joining me today for this look at down payment assistance co-ownership shared equity program. I hope this helped clarify whether this approach is good or bad for you. If you found this useful, please give the video a thumbs up and consider subscribing for more real estate tips. And if you have any questions or experience with co-ownership programs, drop a comment below. I'd love to hear from you. Until next time, happy house hunting and take care.